You're 60 years old, you've got $2 million saved, and you're wondering, how do we reduce the taxes that we'll pay to the IRS over our lifetime? A common question I get is, how do we give the least amount to Uncle Sam? And today we're going to walk through a sample case of a hypothetical couple and a hypothetical example showing 5 ways that they can potentially reduce the taxes that they can pay to the IRS, keeping more of their hard-earned money with them and in their pocket and their accounts versus paying it out to the IRS in taxes. So let's get started. In today's case, we've got, and again, sample case, hypothetical couple here, Steve and Sue Sample, both born in 1964, so they are age 60. And you might be thinking, wait a second, well, why are we looking at their cash flow? Shouldn't we just see how much they have in IRAs and start talking about Roth conversions? As I mentioned, we're going to talk about 5 ways they can potentially reduce the taxes that they'll pay to the IRS over their lifetime. Roth conversions being just one of them. And there's actually the cash flow statement plays a really big role in their tax plan. And there's things on this cash flow statement that we're going to go through and we're going to come back to show you how they could potentially reduce the taxes they're paying to the IRS. So let's start with cash flow. Both looking to retire at age 65. They said, hey, we want to go until health insurance starts. Planning horizon, also very important here. I'm going to show you where that comes into play in regards to their tax projection. So we've got Steve living till age 85, Sue living till age 95. Next on the list here is their lifestyle needs. How much do they need for their retirement? So they need about $9,000 a month. They also want to front load their plan. What does that mean? You may have heard me talk about that before. That's where we help clients spend more money up front where they're youngest and healthiest, understanding that in those slow go years later on, they might not be spending as much. So for travel and other activities, they said, hey, we want to just have $15,000 a year from once we retire through age 85. And then Steve and Sue also brought up to us that they love that they give to charities. One, they give to their church, and then they give to other charities throughout the year. When we talked about how much that was, it was about $15,000 a year, and they want to continue to do that throughout their lifetime. All right, next on the list here is Social Security. So Steve's Social Security at full retirement age would be $3,000 a month. Sue's would be $2,700 a month. Putting together their plan, it had made most sense for Steve to start his Social Security at age 70 and Sue to start hers at age 67. And this is an area as well that we might talk about when it comes to potentially reducing their taxes. They are both still working. And we've just put in an amount here. You're going to see where this comes into play in the tax projection. So they've each got $110,000 coming in each and every year until they retire. And then you can see once they retire, they don't have any other income sources like pensions or rental income. So that could change if you do have that coming in. So as I show you some things, you have to kind of keep that in mind. And then right now they're both saving into their 401ks. 15% of their salary, and then there's a company match on top of that. Okay, so we've got Steve and Sue Sample. That's where they're at from a cash flow standpoint. And now let's take a look at their total financial health. How much money do they have saved, and where is that at? Well, jointly, they have a brokerage account with $600,000 in it. And then Steve and Sue had worked from some previous jobs. What they did was they took those old 401ks and rolled them into IRAs. And so they both have IRAs and 401ks totaling a total of $1.4 million there. And you can see we've started to break things up into different columns. Really important when you're thinking and talking about your taxes is looking at your money the same way that the IRS would look at it. The taxable column, the tax deferred column, and the tax-free column. And so as we can see here, they've got $600,000 in their taxable column. In the tax deferred column, they've got $1.4 million. That's the money that has not been taxed yet. So as they were putting this money away, they got a tax deduction. And every dollar that they take out of this column in their future, they're going to have to pay income tax on. Now, overall, they've got $2 million in investable assets. What's that mean? That's money that they can utilize to live their lifestyle, for that $15,000 a year for travel and activities, and to donate to charities or to their church. That was part of their plan as well. And so if we continue down here, not playing as big of a role, but just so you can kind of see what's going into the overall projection, the residence is worth about $550,000, and they do not have a mortgage. Their home is paid off prior to age 60 here and prior to their retirement. So one of the first things that we want to take a look at for Steve and Sue Sample is we want to look at their tax projection. What's their taxable income today, and what is their taxable income going to look like in their future? Now, one of the things that I forgot to mention there as we were talking about Steve and Sue Sample is how they are allocated. So when it comes to the allocation of their accounts, they are 60% in equities, 40% in fixed income. And just so you kind of have an idea as we're going through the projections here of the type of growth that they're looking at in their accounts. Okay, so with that, like I mentioned, now we want to take a look at what does their tax projection look like, and then we can utilize that to start getting into the 5 ways that Steve and Sue Sample here, our hypothetical couple, could potentially, the 5 ways that they could use to potentially reduce the taxes that they're going to pay to the IRS. All right, so diving in, taking a look at their tax projection. To me, this is so super important to put together for not only your retirement, but your pre-retirement. As I mentioned, Steve and Sue Sample here, they're still working. They have 5 years before they retire. Now's the time to start planning. When they start doing this tax projection, they're probably going to look at it and go, oh, I wish I would have started planning years ago, because there's changes that they may have made or wanted to make in the past that would have helped them, again, potentially save on some taxes that they would pay to the IRS. So first, looking at the tax projection, the shaded blue area here is their taxable income. Well, what does that mean? It means the amount of income that they'll have coming in that will get taxed. And today, that would be their employment income. They've got each $110,000 a year coming in. Now, taxable income means the amount of income that you've got coming in, less any sort of deductions, less the standard deduction. That's what gets to your final taxable income number. So what's coming in, minus any adjustments, minus any deductions. So today they've got their employment income coming in, but guess what? They're putting into their 401k. They get the deduction for that, plus they get the standard deduction given by the IRS. Then once they retire at age 65, as you can see, they actually won't have any income coming in. Now you might be thinking, wait a second, but how are they going to manage and live the $9,000 a month and the $15,000 of activities? Well, they do have that taxable account with $600,000 in it. That's the account just in our projection here where they'd go first to get money to live off of. And then as you can see here in the 70s, particularly age 72, age 73, next thing you know, there is a jump in the amount of income. Why is that? Well, in your 70s, you have to start taking those required minimum distributions from your IRA and 401k accounts. That's forced income, required minimum distributions, forced income that you have to take out of those accounts that you will get taxed on. And you're going to pay income tax on those dollars. And so again, for Steve and Sue Sample, everybody's priorities are different in retirement. But for them, their priorities were, how can we pay the least amount of taxes to the IRS over our lifetime? So there's a lot of different things people would do with their plans. That was just one of their highest priorities. So as I go through the 5 examples today, keep that in mind, that those were their priorities for their lifestyle, or for their retirement. So first, we're looking at the taxable income. As you can see here, from left to right, retirement's those years in the right, it does appear that their taxable income will be higher in the future than where they're at today. Now, let's take a look at the tax brackets. So taxable income projection, what does that mean? What tax brackets will they be in? Well, as you can see here, we'll start from the left-hand side where they're at today. They're in the 22% tax bracket, and then it jumps up right there to the 25% bracket. And you might be thinking, wait a second, but they're not making any more. They still have the same salary coming in. Why did they jump up? Well, at the end of 2025, the Tax Cuts and Jobs Act expires. Once that expires, all tax rates will change. And so most likely you, everyone will have a tax increase when that law expires at the end of 2025. Now, going back here to our tax brackets, then as we talked, once they retire, they'll be down in that 10% bracket. And then they start again, probably needing some money out of their IRAs. They have those required minimum distributions coming in, and they're right there in the 25% bracket for the majority of their retirement. And then you'll see right here, age 86, a little bit of a jump. Why the jump in the tax brackets? Well, if you remember here, and we're going to go back to their total financial health. If you remember here, I was talking about longevity, planning horizon. We said, hey, what if Steve were to pass away at age 85 and Sue were to live to age 95? Look at this, 85, 86. That's right when Steve passed away. Sue is going to jump up a tax bracket. Why is that? Well, she's single and taking in the same amount of income. You'd have to go look at all of the tax brackets, but for a majority, a single making the same amount of an income as a couple most likely is going to get taxed at a higher rate. So there we go. There's the overview of the taxable income and the tax brackets. Now, how do we use this information, and what are the 5 ways that Steve and Sue Sample can utilize to reduce their taxes? And before I go into that, just remember this, and I'm going to show you something on the distribution screen here. I want you to remember this. Just because this works for Steve and Sue Sample, your situation may be different. You might have pension income coming in. You might have rental income coming in. Your Social Security income might be different. You might need more than Steve and Sue Sample to live. You might need less than Steve and Sue Sample to live. So it's really important that you put together a tax projection for your specific situation, looking at each and every year of your life and what will that taxable income be. That's what we do for all of our clients because they all have very unique situations. They all have different amounts of income coming in. They have different plans, different amounts that they want up front versus what they want later on. They have different amounts in their IRAs versus their Roth IRAs versus their taxable accounts. So you need to put something together for your specific situation. Okay, so with that, what then is the first thing that Steve and Sue Sample could consider here to help reduce the taxes that they'll pay to the IRS? Well, let's go back to their cash flow statement here. If you remember, Steve and Sue Sample here, they were contributing to their 401k. So using that information, let's now go over to the tax brackets. And I want you to think about something here. They're putting to their 401k. Putting into their 401k means they're taking a tax deduction today, meaning they're saying, hey, the 15% that we're putting away, we don't want to pay taxes on it today when we're in the 22% bracket. Instead, we want to pay taxes on it in the future when we'll be in the 25% bracket. That's backwards, right? Or, hey, we'll pay it, one of us passes away, we're going to have to pay 28% on it. So the first thing that Steve and Sue Sample can do here to reduce their taxes is instead of putting money into their 401k, they can switch over to their Roth 401k. Pay tax today. Pay the 22% today. Get it into the tax-free bucket. Let it grow tax-free. Then all of their withdrawals in the future would be tax-free as well. All right. Number 2, Steve and Sue sample to help reduce the long-term taxes that they'd pay to the IRS, they can consider doing Roth conversions. Now, what is a Roth conversion? A Roth conversion is taking money from your IRA and converting it over to your Roth IRA. So let's again go back here to their total financial health statement. They've got $1.4 million in their tax deferred account. Remember when we were looking at the tax projection and it showed in the 70s how all of a sudden that taxable income kind of went way up? Well, that's because of all the money sitting in the IRAs. And so what a Roth conversion is a Roth conversion is taking money out of this tax deferred bucket and shifting it over to the tax-free bucket. When you do that, you have to understand you're going to pay tax today on that money to get it over into the tax-free bucket. So you pay tax today to get it over to the tax-free bucket. Why would we do that? Well, let's just take a look again at their tax brackets as well as taxable income. Again, maybe pay 22% today versus paying 25% or 28% in the future. Another good time period for them to do Roth conversions would potentially be once they retire. Here in their 65, 66, 68, 69 through 70, when they're in that 10% bracket, pay tax today versus paying 25% or 28% in their future. Now, there's a very interesting thing that everyone should consider when doing Roth conversions. First off, make sure you talk to a tax professional as well as your qualified financial professional before doing Roth conversions. One of the things that I find that sometimes people can make a big mistake on is they hear about Roth conversions and then they just start going and converting a ton of money from their IRAs over to the Roth IRAs. And that could be a really big mistake. Reason being is if you look at Steve and Sue sample here, all of these lines in here are actually different tax brackets. And as you can see, they'll never go above the orange line throughout their entire future. But if they were to take $1.4 million and convert it over to Roth IRA, guess what? It's going to push them above that orange line, push them into tax brackets they'd otherwise never be in. And so when it comes to doing Roth conversions, it's taking a strategic approach where you go up to a certain line, but you don't want to go over it. And so that's the second thing that Steve and Sue Sample should consider is Roth conversions and being strategic about it, going up to a certain bracket, but not going over. All right, before we get into number 3, 4, and 5, I wanted to make you aware of our free guide to unlocking hidden tax savings opportunities. You can get this at lifemoneyshow.com/taxes. Again, lifemoneyshow.com/taxes. It's going to walk you through a list of different actions to help you potentially reduce your taxes, the amount that you'd pay to the IRS, reduce the taxes on your IRAs and 401ks, potentially by hundreds or thousands of dollars. So you can get that at lifemoneyshow.com/taxes. Now with that, let's move in to number 3. What's the third way here our hypothetical couple could reduce the taxes that they'd pay to the IRS? And this is actually going to take us back to the total financial health statement, and we're going to take a look at where their money sits. We said $600,000 in the taxable account, $1.4 million in the tax deferred account. And if you remember at the beginning there, I said that they had put all of their investments at the same allocation, 60% in equities, 40% in fixed income. Well, this is another area that they can consider to potentially reduce the long-term taxes they'll pay to the IRS. You see, when I say fixed income, for a lot of people that means bonds or bond funds. Bond funds pay out what? They pay out interest. Interest in the taxable bucket, in the taxable column here, we've got $600,000 here. Interest in the taxable column, you pay ordinary income tax on that interest versus equities, which kick out dividends, or if you buy and sell, if you're buying and selling, could kick out gains. Well, gains, if they're long-term gains, dividends, if they're qualified dividends, get taxed at the long-term capital gains rate, which is lower than your ordinary income tax rate. So where am I going with this? Instead of having the same allocation across all of their accounts, well, that allocation is maybe adding interest to their taxable bucket. Adding interest to the taxable buckets, adding ordinary income tax to their tax picture. So one of the things that they could consider doing is taking more of an equity focus in their taxable bucket. That way, now they're looking at long-term capital gains rates, which are lower than your ordinary income tax rates. But you might be thinking, but wait a second, what if they need that fixed income in their portfolio? Well, you take more of an equity focused in the taxable account, and then you just take a more of a safer approach or fixed income focus than in the tax deferred account, because you're always going to pay ordinary income tax on the money coming out of your tax deferred account. So why not put the interest bearing funds in that account there, because you're always going to pay that ordinary income tax. So it's just a different way for Steve and Sue Sample here to think that will take, again, and help reduce the long-term taxes that they're going to pay to the IRS. All right, strategy number 4 that Steve and Sue Sample can consider to potentially reduce the long-term taxes that they'll pay to the IRS, and that is delaying Social Security until age 70. Now, if you remember here, Steve was going to take at age 70, but Sue was going to take at age 67. Now, I realize a lot of times Social Security is a very I'll call it controversial topic of when people want to take it. You have to remember here in this hypothetical example, Steve and Sue Sample, their main focus was reducing the taxes that they'll pay over their lifetime. One of the ways to do that is delaying Social Security. And here's the reason why. You see, if they're going to also do the Roth conversions, when you do the Roth conversions, you pay tax today on that money. That's taxable income that you pay today. Well, based on that Roth conversion amount that they decide to do, up to 50% or up to 85% of their Social Security could then add in to their taxable income. So it's doing two things. It's reducing the amount of Roth conversion that they can do, plus it's increasing basically the taxes that they're going to pay overall and on their Social Security. So if their goal is to reduce taxes, one of the things that they might want to consider then is delaying both Social Securities until age 70. So the fifth thing that Steve and Sue Sample may want to consider to reduce their taxes is charitable gifting strategy like a donor advised fund. If you remember when we were looking back through their cash flow statement, see, I told you that this cash flow statement becomes really important in helping people know and understand what strategies may apply to them. They're giving $15,000 a year to different charitable organizations. So right now, giving $15,000 a year, and based on everything that we took a look at, they're actually not getting a deduction for giving to those charitable organizations. That's because the standard deduction for the two of them is $29,200, again, in the year of 2024. So they are getting the standard deduction. Their charitable contributions, if the standard deduction's up here and their charitable contributions are here, well, the standard deduction wins. They don't get both. One of the things that they could consider is doing a donor advised fund. That's where they put multiple years of charitable gifts into this donor advised fund. They don't then have to use it all at once. They have their lifetime to be able to give that away to the different charities that they want to. So let's think about this now. The standard deduction was here. They're given $15,000 a year. Well, what if instead they put 3 years into the donor advised fund? And you might be like, well, I don't have the income coming in to do that. And they don't, but they do have that taxable account that they could take the money out of. Heck, if they had appreciated securities in there, they could use those. That's going to help them even more. See, I told you, there's more than 5, but we're just going over 5 today, but I could go over more and more and more thoughts and options and ways that they could potentially reduce their taxes. But hopefully it's just showing you that there's more than just a Roth conversion to potentially reduce your taxes. Okay, so $29,200, $15,000 a year. Let's just say they do 3 years. Well, now all of a sudden they're doing $45,000 in 1 year. They're way up here and the $29,000's down here. they put all of that in 1 year, guess what? That's more than the standard deduction. So they'll be able to itemize their deductions that year. They'll get the full $45,000 deduction in the year that they put that money into their donor advised fund. So now they are getting the deduction for everything that they're giving to charitable organizations. And then guess what? Next year, they'll get that $29,200 again. And the year after that, right? So now they're getting the best of both worlds when it comes to getting the deduction on their taxes and plus trying to help maximize the large standard deduction that they get right now. So before, they only got one of the two. After, they're now going to get the charitable deductions year one, but then they still in the future years get those large standard deductions. So just another way that our, again, hypothetical couple here, Steve and Sue Sample, could reduce their long-term taxes. Now your situation might be a little bit different. Maybe you have more income coming in. Maybe you have a pension or more Social Security or less Social Security. Maybe you have more or less sitting in your IRA or your Roth accounts or your taxable accounts. And if you're wondering if these 5 strategies or others would apply to you, if you're wondering how to reduce the taxes on your IRAs and 401ks, or just how much you can spend in retirement and how to front load your plan and spend the most that you can while you're young and healthy, well, we help people just like you each and every day answer those questions. And it all just starts with a 15-minute phone call. You can go to lifemoneyshow.com and click on the Work With Us tab. I hope that you've enjoyed today's video, and if you found it of value and benefit, you want to see additional videos on retirement topics like reducing the taxes on your IRAs and 401ks, on Social Security. Subscribe to our YouTube channel. That way you get notified as we're coming out with new videos each and every week on topics just like those. Thanks, and have a great day.